Investors are anxious. They are quite anxious, and if you are the one who's regularly investing through SIPs, you're wondering whether to redeem, pause, or continue with these investments. In such a scenario, what should you be doing? We'll discuss this in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
As I said, equity markets are in a wobbly state and people are wondering what to do about these negative returns on their SIP investment. What is the reason behind it? Let's get into that first.
No, the reason is that markets are cyclical. Markets, when we talk of equity, we say that equity proved to be the best performing investment class over the long term, 5-year period, 10-year period. But it never happens in a nice smooth straight line. It is not, when we say that it beats inflation, it beats fixed income. Assuming fixed income gets you 8% and you get 12% from equity on a 10-year basis, 5-year basis, it actually doesn't happen in a manner that, you get 12% every year. It is not a 12% yielding fixed deposit. What happens is that ownership and diversification, that diversification reduces risk. And ownership ends up, getting you superior return. And in the interim, markets are like this only. So, we like, or we are interested, we are motivated, we start our investment. Investment is a very positive action. You're trying to grow your money, and it is all filled with all that spirit and understanding. And when you see that your investments are not performing on an ongoing basis, on a day-to-day basis, you see all the bad news. So, investors get shaken by this. More so new investors, because first-time investor, you remember all these years we have been talking about start with a balanced fund.
Correct.
In the good times. First-time investor.
Move on accordingly.
Superior stability. Balanced funds are not crumbling the way equity is. Then don't have small cap and mid cap dominate your portfolio. That is also coming in very handy. So what I'm saying is that equities will be like this only. Sometime it will go up dramatically and some years it will struggle, and we are in the struggling phase. Even last year was not all that great. But if you remember what happened in 2017, small caps went up by 50-70%.
Correct.
Most investors were up 25, 30, 35, 40%. Right now what we are finding is that all the new investors, last 2-3 years has been a great time for, mutual funds were promoted aggressively. SIP Sahi Hai campaign happened. A lot of new investors came into mutual fund and they started their SIP. And they did their SIP and now they are 1.5 year, 2 year old. And when they see that all the SIP, 5,000, 10,000 rupee SIP that they have been doing, they were sitting on some gains 6 months back. Now it is, all their gains are wiped out. It's nominally negative. That negative return is quite unnerving for a new investor. So, investors have to really take a lesson that it's part of the game. It happens and it will keep happening. And in fact, it is a good news because you will be able to buy cheap. And this is nothing, unusual in the course of the market in 5, 10, 15 years time frame. It will happen once again and markets will boom again after some time. But looking at things, fundamentally, things are disappointing. Many sectors are struggling, and that is why stock prices are, the market is not going up. On many occasions, it goes down. We are getting bad economic numbers. Automobile sales declining dramatically in the last 2-3.
Sentiments aren't good.
Sentiments are bad. No, but that's just not about sentiment. If companies don't sell enough car or there's a huge deceleration in the thing,
what can you do? Yeah.
Then there will be less profits. It's well anticipated. Stock market is a place where the business future gets discounted in today's value. So understandably, the market is discounting that the immediate future is not so bright, or it's, if not bleak. Or it's disappointing than what it has been or what was expected. But I think, it's part of the game. If you are investing for 5 years and more, remember our first rule, that invest your 5 years and more, money which you are unlikely to need for 5 years and more should be invested in equity. Never invest lump sum. because if somebody would have invested lump sum, he will be witnessing, big decline. So if you are doing these two things and you still have that time on your side, carry on. These are important times. There is absolutely no point doing SIP in good times and not doing it in bad times. Bad times, investing through bad times will only enhance your return.
Okay. So what you're advising, as what I understand, is that continue with your SIPs.
Keep calm and carry on.
Keep calm. But so difficult, when you
it
see your
difficult.
wealth. When you see your wealth going down, what you have invested, the value of that coming down. So
that's the price you have to pay for being wealthy over a period of time. If you want to be wealthy, and you think that there's a guaranteed way to be wealthy in 1.5 years time, 2 years time, and you can time it perfectly, I'm sorry, you'll be disappointed. In fact, you will get poorer, because if you try and time it perfectly, you will end up, doing the wrong thing. You will actually take a misstep.
But the only silver lining I see is that, as you very rightly said, the values are down and you get more shares now.
You get more units, and and also I find that market is attractive on 2-3 dimensions. One is that you'll be buying units cheap. Good businesses were very expensive because the universe of the market, the part of the market which was high quality companies doing very well, and those companies will continue. One has to understand that there is a difference between companies doing well and stock market doing well. Many companies will continue to do well. They will do little poorly than they did in the recent past, but the market actually takes a very knee-jerk view of things. If a great company which has done very well over the last 25 years, it has been a wealth building, it has contributed to somebody's, making a lot of money in a sustained way over a period of time. And now we are, and it was growing at 25% every year. And now if it is going to grow at 22%, market discounts it dramatically. That stock will also be down 20%, 30%, 40%. And it will bounce back again. A good part of the market is still reasonably priced and might be still expensive. I think it's important that people buy equity fund, or if you haven't started, if you have been waiting, then it's about time. In taking a contra decision on this front in terms of investing your long-term money, being regular about it, buying cheap, and this is a price you pay to be wealthy. This is you have to really withstand you have to resist the temptation, that you have to really overcome the fear.
So stopping SIP is not the solution, because as Dhiren says, you buy cheap now, you get more units, and of course equity is the only way. This I heard from him.
Equity is the only way to build wealth.
To get wealth. And also fixed income products in comparison do not give you.
Tax efficient. They're not
tax efficient at all. So the advice, if we were to put it into a summary part, how would you go about the do's and don'ts for the investors?
Same do's. Long-term money should be invested in equity. First-time investors should start with a balanced fund. If somebody has been used to it, has been used to the market or the wild movements of the market, then be in an all-equity fund. Keep it simple. And don't stop your SIP. This is a bad time to be stopping your SIP. And
don't speculate also.
And don't speculate. You have to really see that our business is going to disappear. Is economy? Yes, economy is struggling, and so are companies. So are many companies in many sectors. But is it all that bleak? Will companies is the prospect of companies such that everybody will face bankruptcy and they will disappear? No, but that is the kind of feeling that I find. I've never seen this kind of pessimism gripping the market in such a brief period of time, and I don't see a rationale for that. This is a cyclical downturn, and also I feel that happy families are all alike. When good times in the market, but every every unhappy family, what Tolstoy said, has its own unique story. Likewise, I find that the story on different sectors, which is dragging many sectors and having an impact on the market, is of an unusually different kind. Pharma has a different story. It is affected by something which nobody can control and nobody can anticipate. US FDA doing the investigations that is leading to the transformation of the business model of the generic and the bulk drugs that we supply. Look at the telecom, consumer is benefiting and companies are struggling. It has been one of the biggest wealth destroyers for Indian investors. Look at the public sector bank. It has undergone a transformation. We have seen this big, consolidation of the public sector bank. We'll be left with few. Government is trying to solve the problem. I don't know whether this problem gets solved or not, but we are definitely moving ahead in terms of taking some actions, hoping that things will improve. Likewise, the consumer confidence that we see. More importantly, if you look at the macro factors affecting businesses, the way business is conducted in India has undergone a radical change. The way we used to pay taxes and the way the auditors are auditing now, I find a remarkable difference in the way businesses are trying to be compliant and being sensitive to being compliant. Look at the real estate, the sector which actually provides all the employment and provides all the confidence. It was easy for anybody to be launching a project, a housing project, and not worried about it. Investors were taken for a ride. Now, Real Estate Regulation Act, this is a whole new thing. Now, builders are careful about, launching their product, and they have to be serious about, honoring their commitments. Likewise, so I think every negative story, look at the Bankruptcy Act, the way it is having an impact. For the first time in my 30 years of running value research, I find that companies are going bankrupt. People are losing their company, promoters are losing their company, companies are shutting down if they are unable to honor their commitment. Look at what happened to Jet Airways, the change of ownership of Bhushan Steel. These are still early days. So I think, this huge transformation which we see in the business environment, it is for the good, it is for the better, it is for superior efficiency, it is for greater efficiency, and it will make markets more efficient, businesses more competitive. And look at GST, the way things will be recorded and captured, and of course it requires reforming, tweaking, fine-tuning it. It is actually causing a lot of problem for businesses, and maybe it is actually impacting the consumer confidence because people are busy fixing those things. But I don't think it is of a permanent nature. This is going to have a definite positive impact, whether it takes 1 quarter, 2 quarters, 4 quarters, and happens gradually with different sectors. But the big consumer base that we have, the kind of opportunity that India provides, I think matter of time. Don't give up. Never give up on an occasion like this, because your loss will be permanent if you give up now.
That's very well said. Your loss is going to be permanent if you give up now. So historically, or if we go back in time, say 2008, how we all came out of it, that time also was cyclical. I would like you to just give some kind of hope to the people, because there are people who are down and there are people who are anxious. So if you can just in a few seconds give them...
2008 was worse, because what happened in October 2008 was that we used to watch the TV in the late at night, that how the American markets are opening, and we were witness to the big global banks failing, Lehman Brothers closing down, apprehensive about other things, AIG, the biggest insurance company, collapsing, the housing mortgage refinance company in the US, Fannie Mae and Freddie Mac, both collapsing, or they being rescued by the government. So that was the absolute complete lack of confidence in the financial system. It was disruption, and it was having an impact. Of course, we had no reason to be that affected that much, but in a globalized world, it's very difficult to insulate yourself from all that. So what we saw was 50% decline in a conservative fund, 35% decline in a balanced fund in a span of 1 year. Small cap funds went down by 80%. So that kind of steep decline in a brief period of time, we are nowhere close to that. We have seen all these things, we are witnessing all these things happening gradually. I also feel that all the changes which everybody is struggling with, which is having an impact on the business confidence or slowdown or whatever, I'm still not very sure what all is going on. Nobody knows, everybody knows that there is some problem. Nobody knows
Exactly.
What to do. And nobody knows, and I don't think it is anybody's fault. This is something, it has happened gradually. It is a result of a set of actions taken over a period of time, and they are all good actions. They are all good actions for the long term. A buyer buying a house and has greater assurance of getting his house. I don't think this is a negotiable thing at all. Bankers lending money to a business and being assured that he will get his money back, or he will have a recourse to the loan with the mortgaged assets. I don't think I don't think it's a negotiable thing. Rest of the things, it'll happen at its own pace. Don't give up. Things are not all that bad. We are nowhere close to 2008, and lot of problem areas that has been, we are well on track to solving them. Look at the PSU bank, the kind of recapitalization that has already happened. I don't know when the market will acknowledge it, because market does not acknowledge till it sees the money on the table.
So what the crux of our discussion is that hang in there, no matter what, hang in there and continue with your SIPs. It's time for us to move on to the Q&A part of our program, and we'll be taking up the queries, the questions that you have sent us. Okay, Dhiren, our first question is from P. Sanjeev. I have noticed that GILT funds are giving much better returns than most of the other debt fund categories. So is it advisable to invest my retirement corpus in them for the next 3 years? Can I expect a return of 10+%?
No, I would like to warn Sanjeev that don't get carried or attracted by the recent, GILT funds definitely are showing a 15% return over the past 1 year. So that is very tempting. 15% while so equity is struggling.
At least you can get 10 then.
No, but the real point to consider is that the same GILT funds gave only 6% last year, and the same set of GILT funds gave 2% in 2017. So understand what GILT funds are. GILT funds are absolutely safe in terms that GILTs are nothing but government securities. So these are government bonds, and fund managers invest there. But that doesn't mean that you can't lose money. You do lose money, and many funds do lose money. When interest rates go up, then these funds actually fall in value. When interest rates go down, these bonds, the older bonds which the funds were holding, appreciates. And that is why we are witnessing this. We have seen the decline in interest rate in recent months, and that is why. And there could be few more rate cuts. So these funds can continue to deliver superior return for some more time. But for some investor like you, who is about to retire and is looking for predictable return, I think play safe, because if interest rates go up, one is that if interest rates stabilize, then these funds will actually not deliver the kind of return that you are witnessing. 15% is a very extraordinary thing, which has happened entirely because we have seen 3 successive rate cuts. That might take longer. So these returns will stabilize at 8-9%. Otherwise, if interest rates do go up, which at some point they will, because that's the only thing which
there can't be a drop in the percentage.
To a certain point, it can't go down to 0. So, and we have come down reasonably. So from that standpoint, I would say that you will be better off playing it safe with the kind of money you are referring to, your retirement corpus. The money, so it's just consider the fixed income option to consider is ultra short-term bond fund only. Don't take a rate view and try to benefit from that, and don't chase recent past performance when it comes to fixed income funds.
Okay. Kanan Nader has written in saying, how do you compare NPS and PPF? Which one should I choose to invest?
They are not comparable. NPS is a portfolio, and you can actually choose your allocation, you can choose it. So it's almost like a mutual fund targeted to retirement. PPF is fixed income yielding, guaranteed fixed income yielding, and both are tax free, in a sense that the appreciation, the money that you invest up to 1.5 lakh rupee is tax exempt. You get a tax break on that. It appreciates, and you are not liable for any of the tax, tax on any of the gains. Likewise, in PPF, the interest that you earn, you don't pay any taxes, and even the withdrawal subsequently on maturity in case of PPF after 15 years, in case of NPS when you attain the retirement age of 60, you take out, and that is also tax exempt. So it is all EE, exempt when you invest, and you get a break too. But I'm hopeful that on any period of 10, 15 years and more, NPS with a highest allocation to equity will give substantially superior return, because the charm of NPS is that it has the lowest expense, it gets you an equity exposure, and it gets you all the tax break. So from that standpoint, you should consider NPS if you're trying to maximize your return and be regular with your investment. It's like nothing but a mutual fund, which can have maximum 75% allocation to equity, and but your money is stuck till your age of retirement, and so in the case of PPF for next 15 years.
Okay. Ashish Goel writes in saying, I have a saving of around 10 lakhs. Would it be wise to use it for buying a house with the help of a home loan? I am currently living on rent and pay rupees 17,000 for it. My monthly take-home salary is around 72,000 rupees.
Yes, you are the home loan is the only thing which I suggest people should borrow, because and more so in case for a person like him who will be able to buy the house, live in it, and save on that 17,000 rupee, which is the rental outflow. Don't consider buying a home as a second home or as an investment, or if you are going to buy a house in which you are unlikely to be living, that's not a good idea. So in your case, it makes eminent sense. Just do your calculation. If I have to really frame a home buying guideline for him, make sure that you are not paying more than a third of your income, of your 72,000 rupees divided by 3, which is 72,000 rupee.
Okay.
So 20 and 4, so 24,000 rupees should be your EMI maximum. I'm just framing it just so that you are not losing the basic framework of financial prudence, and you have to buy a house where the down payment of 10 lakh rupees, or you have to wait to buy the house where your down payment is such that the installment or your EMI for the home loan is not exceeding 24,000 rupees.
Okay.
And make sure that you are buying a house in which you will start living in it to save the rental outflow in near future, soon after buying it.
Is it fine for a husband and wife to make SIPs in the same set of mutual fund schemes? And this has come from Rohit Daniel.
Yeah, absolutely. If you have chosen two good funds, then husband and wife should be investing in the same fund as well, so that they both are interested.
And how wise will it be to take a personal loan for investing in mutual funds and stocks? And this has come from Meera Ramesh.
It's a very undesirable thing. It's a very dangerous thing. If you succeed, then you will become a speculator. If you fail, then you will be in misery, because you will be paying the interest and your investment has also lost value. So either way, one should never borrow money to invest in equity because of the unpredictability, because borrowing money to invest, or borrowing money itself is like a taxi. The meter clocks every day. You are liable to pay that. So even if you are borrowing at a modest, basically you are trying to make an arbitrage, that you are borrowing at 12% and hoping that it will get you 15%, and 3% will be return on the money which is not yours. Assuming that this market goes down by another 10%, so you will lose your sleep. If it goes up by 20% and you are able to make a handsome neat profit, you will become a speculator, and one day you will lose all of it.
Okay. The next question is that since the auto industry has gone through heavy correction, will this be the right time to invest in auto sector mutual funds? And this has come from S.K. Sharma.
It has gone through correction, but why do you think that you have to buy a auto sector mutual fund? One is that there are not too many auto funds. auto sector funds. There are one or two. But besides that, I would say that every diversified fund also has auto stocks. And so your fund is diversified and a certain part of it is in auto companies. And as and when they make a comeback, they will, if you are, unless you have some specialist understanding, and if you have that special understanding, then why not buy auto stocks directly? Buy one or two or three leading companies where you think that they will make a big comeback, but that's a private decision. I think, most ordinary investor, or particularly the kind of investor who are watching investors hang out, they should keep it simple. Diversify, not take a sectoral bet, keep it simple and be regular with it. And you have hired a fund manager so that you don't have to take these calls.
Correct.
Fund manager will try and emphasize something in his portfolio, keep away from something, emphasize something in the portfolio at the opportune time. So leave it to him.
Indraneel Mitra has written, should I go for the mutual funds or stocks to invest for the education of my child who is presently in KG?
Yes, one should be investing in equity.
Actually,
for if your child is in KG, because this is a 15-20 year for higher education, if that's the money. But going for equity fund or going for stocks directly is entirely a matter of your capability, your interest and your temperament. If you have the time, if you are interested, and if you are curious to know about different companies, and you have temperamentally you are suited to choosing stocks, building a portfolio, diversifying yourself, it's a great thing to do. But if you think you'll be too busy doing it, you may not have the time, don't speculate, don't go to a stockbroker and find, say that what should I do now? You'll be misled, you'll be taken in a different direction. Be methodical about this, and if you can't be methodical about it, choose a fund, start your SIP. This will turn out to be a fairly rewarding thing given your time frame.
In the long term.
Yes, there's a 15-20 year time frame.
Clear. That's all we have in today's program. Continue to invest as Dhirendra has advised you, and continue with your SIPs. Thank you, Dhirendra, for answering the queries of our viewers. And till we meet next time, this is Rajesh Lake and Dhirendra Kumar saying goodbye.